Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Mark Marex, Senior Director of Index Research at Nasdaq, as well as Andrew Nelson, Director of Product Strategy at Innovator ETFs. We're here to discuss how advisors can participate in this market near all-time highs, but with protective guardrails in place. It's great to have the both of you with us. Welcome to Trade Talks. Andrew, let's kick it off with you. We know there's a growing concern over a potential AI tech bubble. Give us your thoughts around, how you feel about the markets from a macro perspective and what we're seeing within the tech space right now.
Well, thank you, Jill, for having me. I think you nailed it that we see the potential, of course, for AI, but are concerned a bit in the near term. From a longer term perspective, I think that it'd be hard pressed to argue against the change AI is bringing into the marketplace, both from an economic standpoint, from a practical standpoint, from an investing perspective, even on the longer term. Maybe we're in, say, month two, or I should say inning two or inning three of the longer term cycle. However, in that near term, we are a bit worried about valuations, about the investment cycle, and about, again, over investment in the space. There's some fragility there that we're concerned about. And we think you could do a good job to keep your clients invested, but do so with the guardrail perspective or with some more protection in place.
Yeah, Mark, it's interesting because you and I have covered this a number of times. If we did not get that key theme of AI really emerging in November 2022, just what would the market look like in 2025?
Yeah, Jill, it would look a little bit different, I think. AI, I think, certainly has played the role of being this new secular growth driver, long-term growth driver for the index. But of course, even heading into it, fundamentals were pretty robust. A lot of the major players in the index, maybe you exclude NVIDIA for that, given how much their business has been turned around by this. But a lot of the other major players had really strong fundamentals coming out of COVID, kind of coming out of the difficult environment in 2022. And so, I think Andrew's right. Anytime you get to setting record highs and you see companies going up 20, 30% in a single day, and they've got market caps in the hundred billions of dollars, that's an opportunity to reevaluate the level of risk in your portfolio. That's not to say that, again, we're calling for a drawdown or we're calling for a bear market. We had a bear market earlier this year, right? And I'm sure if investors had some built-in protection, some buffer type of strategies around NDX, they probably did a little bit better going into that bear market, right? So it's all about what are you comfortable with in terms of your level of risk, and what are your goals as an investor in terms of protecting principal versus, getting sort of max exposure to growth. There's a large range and spectrum for both of those.
Yeah, and Andrew, I think there's a couple things here. One, you have to understand what your time frame is, especially when we talk about longer term themes and playing out. It seems to be there's a little bit of instant gratification and FOMO in the market, but there is still a massive place for the longer term investor. So when you think about putting guardrails into place, what types of strategies are you talking about there? Are there buffer types of strategies or other types of ways that you're hedging against a longer term NDX position?
Yeah, Jill, we have a couple of different options. I don't want to, again, speak every ticker that we have here in our book, but I do want to mention QBUF, QBUFF as we call it. It's a way to get a 10% buffer on your Nasdaq exposure, but over a 3-month time period. And so it's over that quarterly window that's important for our conversation today, because again, longer term, you want to have the ability to capture that upside and have a fresh exposure every 3 months, either again, capping your losses in a sense or locking in those gains and participate on the upside. So again, to be clear, you have a 10% buffer every 3 months. The market falls down, say 10%, you're down 0 over that 3-month window. You do have an upside cap. And right now it's in, call it 4-ish% range, but that's over 3 month time period. It's not annualized. So you have that 4% upside over 3 months, roughly multiply that by 4, you're talking 16 to a little higher percentage points per year. That cap can change. But I say that because, again, it's a very dynamic, fluid market. You want to be able to participate and get some fresh upside every 3 months. And so QBUFF is one opportunity that we see as a way to get exposure to the Qs in a risk managed fashion. There's a couple others we can address here in the future, but that right now is one that we see growing in popularity and growing in use, especially around, again, this kind of volatile asset class in the tech space.
What's the difference between QBUFF and QHDG? That's a hedged Nasdaq 100 ETF.
So I went straight to QBUFF as a slightly more conservative investment, but actually Q hedge, as we call it, QHDG. We've covered the waterfront here from the Q's perspective for risk managed solutions. Q hedge differs in 2 ways. One, it actually holds the underlying stocks, equities in the Nasdaq 100, whereas QBUFF is just an options-based portfolio only. And Q hedge is a shifted hedge protection level, meaning we're in that 5 to 15% range. So you are actually on the hook for the first 5% of losses each calendar quarter. But then between -5 and -15, you are protected. With the equity markets there, again, working for you, you get a slightly, again, higher upside opportunity because you've given up that first bit of protection. So from a more generic hedge language, Q hedge certainly fits the bill. QBUFF is a bit more precise, similar in nature, but again, different. And if you were to say, look at the performance year to date, you'd see that play out. Again, Q hedge slightly outperforming QBUFF, but again, on the downside, QBUFF with the better hedge on the downside. So there's just, again, it's a benefit trade-off that you need to make with your end client in play, but there really are different opportunities to invest in the space.
So it sounds like the same type of investor, though.
Same type of investor. We talk about, again, desired outcomes as the primary driver. Is your desired outcome absolute certainty? And you want to have, again, this kind of tight options-based portfolio. Look at QBUFF to know that every 3 months you get exactly 10% protection. Q hedge, slightly more blended view, meaning that because you hold the actual stocks, you do have a bit of movement beyond that, say, 5 to 15% hedge range. It's more of kind of an evergreen portfolio that guys can buy and hold, as opposed to that QBUFF, a bit more time constrained in that sense.
Mark, when you and your team are meeting with different types of advisors and strategists, are you hearing more interest in these types of alternative strategies within the Nasdaq 100 index?
Yeah, absolutely, Jill. I mean, this is the fastest growing segment of the entire ETF industry right now, at least in the US it is, has been for a few years running. We're certainly exposed to that as well. Some of our fastest growing products this year have been in Nasdaq 100 ETFs with some sort of an options overlay. When you think about it, at the end of the day, it all comes down to giving investors choice in how to manage their exposure. These types of strategies, they used to be the domain of, hedge funds, high net worth investors only, institutional allocators paying high fees. This is the democratization, right, of getting, structured finance type of outcomes, even in sort of plain vanilla equity portfolios. So, we're big believers of that. We're big supporters of it. And especially for the NASDAQ 100, when you think about what it takes to create a structured or a defined outcome around the NASDAQ 100, given that the sort of the engine that makes all of this go is the underlying equity index exposure. The fact that, you go back 15, 20 years, we're averaging around 5 percentage points more performance versus the S&P 500, and maybe about 2.5 to 3 percentage points more volatility per year. That's a really, really compelling risk-return trade-off. And it means that you don't have to give up quite as much upside if you're capping that, and you get a lot more downside protection right? Because you're selling options at a higher volatility level, and you're getting more premium in return for that, to do with as you wish, depending on the exact strategy in that ETF. So it's a very compelling space for us, and we think this index is really sort of perfectly designed and situated to participate in that.
All right. Appreciate
Jill, can I add on
of course,
two
yes.
quick points on that? The growth element, absolutely true. I want to make clear that QBUFF, being a fairly new ETF, it's only about a year old, just past it. We've seen about $100 million in flows in the last year, and that's an organic flow. I mean, Mark can speak to this growth of this space as he just did, but that's from folks finding it by themselves, understanding the benefit, implementing it. We saw, again, a lot of interest. You had that initial February market high, that initial tariff tantrum. Maybe we're on tariff tantrum number 2 right now, but we had that drawdown in April of this year. The Qs fell 20+% from peak to trough. QBUFF is down 8.5 approximately over that same time frame. So again, it illustrates in that one little micro segment of just the benefit to clients of protecting on the downside, so you can even dig out of that smaller hole and still stay invested over the course of the full market cycle.
Yeah, certainly does provide some good context to the value of these types of strategies. Appreciate both of your insights, Andrew and Mark. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.